Hi, Umang. So good to have a chat with you. Given the fact today that markets are at 9,500 and valuations seem a bit stretched, but on the other hand, we have expectations of an economic recovery coming through, and whether these valuations can be justified. What is your take on this?
Yeah, thanks, Parinaz. I think this is a question which is in everybody's mind. We have had the last few years, maybe 5 or 6 years, where earnings growth generally has been quite disappointing. So we've of course seen analysts starting with some number and then during the year downgrading their estimates. So that's been a normal thing for the last 5-6 years. But there have been instances where we felt that the probability of earnings growth is higher, is coming back to a higher trajectory. It happened once in 2015 where the probability was quite higher and markets went up to 9,000. Similarly, this time as well, the earnings trajectory change towards the positive looks higher. 2015 was of course very disappointing. The earnings never came, so markets were quite punishing. So 9,000 back, the journey back to 6,800 was quite a stressful one. But this time it looks really strong. This time the earnings growth from sectors which you will not expect, for example steel or metals or corporate banks or infrastructure, that's going to be leading to the earnings recovery for the main indices.
So given this, Umang, what are we recommending for client portfolios, for clients looking to increase equity allocations at this level?
As I said, Parinaz, 2015, so that scenario is very fresh in our minds and also client minds. The probability was looking very high at that time, and most of the investors got caught on a wrong foot. Although the probability this time looks extremely high, but what we are seeing also at the same time is the chance of again a disappointment should not be ruled out. So how do you play equity markets now, considering that the fact that there is looking an upside, but we don't want to get caught on the wrong side. So we saw put option values available on the Nifty. They are available at around 5.4 or 5.5% for 3 years, which means approximately 1.8% per annum. So that hedging cost, if you're ready to give today, you can get an unlimited upside on the markets and full or almost full protection on the downside. So whenever now you're entering equity markets, you should look at buying equities through a put option. The other thing what's been happening is most of the equity allocations, say for example a client has a 40-60 and that was what was decided. A lot of clients are coming back and looking at the liquidity wave, have asked whether should we go from 40 to 60, right? The answer to that is yes, but that 20 additional should be with a put option. So that's what we are suggesting. So a put option would be a key element now going forward, driving incremental equity allocation from our side.
Portfolio with long on equity and put option. When long on portfolio is combined with a put option, when the market goes up, the long only portfolio will have unlimited upside and the put option can be allowed to expire. Only the premium will be lost. However, when the market goes down, the loss made on the long only portfolio is recovered by the positive payoff made from the put options. The portfolio then will have a payoff of unlimited upside and limited downside.
And what would be the best way for clients to invest through this option?
So either the client can always buy options on the exchange, but there is always also a product in the market available on the mutual fund platform. It has been launched by one of the leading asset management companies in India. It's called HDFC Equity Opportunities Fund 2. That is going to have an inbuilt option, put option to protect your downside. So there will be a long only bias as well as the put option to cover your downside. So that option also can be suggested to clients.
Umang, can you share some more details about this fund and its positioning in client portfolios?
Yes. So the HDFC Equity Opportunities Fund Series 2 is a closed-ended fund. The total tenor is 37 months. It's obviously 37 months because it's buying a 3-year put, so it needs to be closed-ended. But what the fund managers are going to do is concentrate on 2 or 3 themes. As I mentioned at the start, that there are some new sectors emerging from where the earnings growth are expected. So one which I mentioned was corporate lenders. So this fund as well will buy corporate lenders. It will also focus on capex revival, so you can expect some infrastructure names in this. The third, there's a massive shift from the informal economy to the formal economy through demonetization and GST. So there will be some stocks where we can play on that. There's also the Pradhan Mantri Awas Yojana, which is the housing for all scheme. So a lot of stocks will benefit from that. So that could be probably the 4th theme. So this fund is going to concentrate on these 4 themes, plus buying the 3-year put option. Total, it's a closed-ended fund with a tenor of 37 months.